Hello, I'm Brian Rezny, president of Rezny Wealth Management and host of the Rezny Wealth Report. We've got a great show for you this morning. Make sure you send your email questions to Brian Rezny at ReznyWealth.com. And of course, make sure you do visit our website. Check out all of our reports, our various programs on TV and radio, and times and availability. And of course, if you're concerned about the advice you're receiving, remember this, folks. You only have one retirement and basically one portfolio. Don't let mediocre investment advice and mediocre returns upset your retirement, because your retirement security is too important. Send us your email questions, or better yet, call my firm for a consultation. Let us sit down, review your portfolio, and see what needs to be done in order to help your retirement get back on track. You know, I'm going to talk a little bit about not only the economy today, but a lot about the investment market, so you can really understand proper management of your assets and make sure that you're doing the right things for your money ultimately for 2017. Emotional investment decisions are dangerous to your money and your future investment returns. And I really want to hammer home on this one today. I had a lot of calls from my TV and radio shows all last year, and this year it even seems like it's ticked up a notch. Investors who were making emotional decisions. I'd get calls on my TV or radio shows that basically said, Brian, I sold everything because, the market was down 8%, and I thought, oh my gosh, I should get out now because the next recession's coming. Or I heard a Wall Street firm say there's a big recession. There was a big Wall Street firm, RBS, that basically called, sell everything call back in January of 2016, one of their analysts, and basically that was a big disaster if you listen to that kind of advice. But at the end of the day, investors need to understand there's a lot of market calls out there. A lot of them are from firms, in my opinion, you should never take advice from. And to tell somebody like the Royal Bank of Scotland did to sell everything is ludicrous. They were expecting a huge collapse in the market and all these kind of craziness. And of course, then people believe this stuff and you start selling. Big mistake. And I'm going to show you why. Worst start of the year was 216, sell everything. That was RBS, Royal Bank of Scotland's call in January of 2016. Let's see what actually happened. As January goes, so does the year, was kind of a buzz line a lot of Wall Street firms were popping out. That refrain, when 216 became, was the worst start ever, by the way. So let's talk about that. Worst start ever in history for January. The January market was down about 10.5%, the S&P market itself. Stocks fell because of all kinds of crazy reasons. Imminent China collapse, or earnings recession, or the election, or this bull market is long in the tooth. They said if Donald Trump was elected, the market would tank right after, and the market went up. So again, stop listening to these Wall Street firms and analysts, because generally speaking, they're almost always wrong, and the advice they're giving you is making emotional decisions happen in your portfolio, and it's causing you to make lesser money. There were plenty of calls to sell everything, by the way, in January and February of 2016, and this is rarely good advice, especially bad in the first quarter of 2016. Had you sold everything in January of 2016, you would have missed a 45% rise in small cap stocks, a 25% gain in U.S. large cap stocks, a 31% gain in emerging markets. Yes. So let's take a look at the numbers. If you had $1 million portfolio in December, or at, let's say, the beginning, January 1st of 2016, and you were mostly in large cap, and let's say your portfolio went down to around $900,000, and you decided to sell everything and take that advice. Well, guess what happened? Not only did the S&P come back to break even, but it actually ended up over 10% gain in the S&P in 2016 by the year end. So if you look at it, things like small cap and emerging markets did even better. So again, Don't listen to this emotional rhetoric from a lot of these Wall Street firms and analysts. Never sell everything. Make sure you have your own plan of attack, or better yet, find a real investment firm that doesn't have the conflicts of Wall Street, banks, and insurance companies that can hopefully provide you more sound investment advice that is better for your portfolio and your future returns. Investment strategy, not emotion or hyped up news media. You know, I've talked about this before. A lot of media is a lot of news hype, and a lot of it's negative, really news media that basically is really there to get ratings for the actual show or the actual news station itself. I've talked about this before. In my opinion, there's probably a 9-to-1 ratio, 9-to-1 negative news to positive news. You know why that is, in my opinion? Because negativity sells ratings, and people will listen to some of this negative news much more than positive. You, the investor, have to realize you need to get that out of your investment thinking and stop listening to, again, this stuff about the world's coming to an end, imminent collapse, huge recession, or sell everything. Again, these market calls are rarely good for your overall portfolio. If you have questions about your portfolio, send them to Brian Rezny at ReznyWealth.com. If you were one of the unfortunate people that listened to some of that rhetoric and sold everything last year, or the advice you're receiving from your Wall Street firm is mediocre or just plain bad, maybe you need to get that second opinion. You have one retirement. Call Rezny Wealth Management or visit our website for information about our firm and how you can properly manage your money with Rezny Wealth Management. Go to ReznyWealth.com, and again, I'll take your questions at Brian Rezny at ReznyWealth.com. Andrew from Fort Myers, Florida. I have only $150K to invest, and I can't afford to lose it. I'm investing in high-yield preferred stocks. Does that make sense in my situation? First off, Andrew, your general comment about you can't afford to lose it. If you put your money into anything other than a CD at the bank or a bank account, you have a chance for some kind of volatility and potential loss of principal. Maybe not permanent capital loss, but fluctuation. So unless you can afford to take some degree of volatility and risk for long-term investment, I'm going to tell you to stick it in a CD or in a bank account, because anything else is going to have some risk. But if you are fully invested in preferred stocks, those have a lot of risk. They act somewhat like stocks and long-term bonds combined. You can see a lot of volatility with preferred stocks, and you could easily drop 30 or 40% in the next recession in the value of your portfolio. So when you're telling me you want no risk or cannot afford to take risk, you're all in one sector, one type of investment that is highly volatile and levered not only to interest rates, but the stock market itself. I think you're making a big mistake, and you probably want to get yourself some real investment advice from an investment firm, because I think you're headed for disaster with that style portfolio. Randy from Bonita Springs, Florida. What is your opinion of municipal bond closed-end funds? They took a small hit last week. The yields of these closed-end funds are reasonable. Randy, and I'm going to talk in general now. I think municipal bonds are probably one of the more overvalued parts of the bond market. When Trump's tax reform comes in and tax brackets are lowered, you may see another hit on muni bonds because rates are cheaper, interest rates, or tax rates, excuse me, and that means those bonds are of less value because, again, municipal bonds are tax-free, usually good for people in high tax brackets. If rates come down, they're less valuable. I think you'll see some kind of a drop. Maybe not dramatic, maybe 5 or 10%. But closed-end funds, I would avoid. I get a lot of investors that call me all the time that own closed-end mutual funds. These often deploy a lot of leverage, 30, 40, 50% leverage. They borrow money to buy more securities. It amps up, brings up the risk a lot. They pay what's called a distribution. Distribution is not necessarily income or return on your money. Distribution might be a combination of interest and return of some of your money each and every quarter in order to pay that higher distribution rate. You need to understand that. Also, the internal structure of most of these closed-end funds, to me, are not suitable for most investors. They're great for Wall Street firms or firms that develop these investments. I think the fees tend to be higher. I think the risk is amplified a lot, and I would really avoid closed-end mutual funds. And I think muni bonds in general are one of the more overpriced part of the bond market. So this goes out to every investor that's listening to my show today. If you own a lot of municipal bonds, I would have serious thought about looking at each one of those positions. Should you be trimming your exposure to municipal bonds, locking in profit, or reducing the ultimate risk in your portfolio from a rising interest rate scenario and a potential drop when actual tax brackets hopefully are dropped and enacted this year, 2017. Eleanor from Marco Island, Florida. I would like to put my husband's IRA and my IRA account into the best dividend-paying stocks and use the dividends. What do you think? Eleanor, first off, by putting all of your money in just some dividend-paying stocks, you're going to take a lot of risk. You have to ask yourself, why are you buying just dividend-paying stocks? Why not growth stocks or value stocks, maybe small cap stocks, maybe a combination in order to get total return? Remember this, Eleanor, what you want to look at as an investor, and I think a lot of investors make this critical investment mistake. They only look at the dividend. They don't look at the value of that stock each and every year. The last 10 years has been going down. They're just looking at the dividend. You need to look at what's called total return. Total return is your principal invested, growing or going down, plus that dividend added together. That's total return. I'll give you an example. If you put $100,000 into high dividend paying stocks, that's paying, let's say, a 4% dividend stream on average, but the portfolio drops 6% each and every year for the next 5, you still got your 4%, but your portfolio drops 6%, you've got a negative total return. And at the end of the day, remember, these companies that pay these higher dividends could cut that dividend completely. In a recession, a lot of dividends often get reduced or cut, and those stocks ultimately drop a lot. I think you're taking too much risk for what you're going to get, and I think what you're doing is you're looking at one small sliver of the investment market. Investors make that mistake also. They'll look at one small sliver of the investment market, leave everything else off to the pasture, when maybe the best opportunities are a more diverse portfolio in other areas that pay little or no dividend, but your total return might be a much healthier, greater number. Pam from Miami, Florida. What do you think of the Apple stock split? Is it a buy because they split the stock? Are split stocks good, or is a stock split good for stocks? Excuse me. Bottom line is this: a stock split is not good or bad for a stock, and a stock split is not a reason why you should buy or sell a stock. If you look at statistical numbers and a lot of research long term, a stock split is not good or bad. And it doesn't really help grow the stock in value. It's really a reason for the company to basically bring more shares into play and basically bring the share price down for liquidity, in my opinion. But it's not going to help you make more money. I think Apple's a good company. I don't think it's a great investment like it was once. Remember, I often talk about various market caps, small cap stocks that are smaller, there's mid cap, and then there's big giant companies like Apple. When companies become very large, it becomes very hard for them to grow their earnings and their revenues. And Apple's fallen into that category smack dab right now. And if they can't grow their earnings and revenue, chances are that stock price will kind of just stagnate and maybe not do a lot for the next 10 years. It might actually go down 10% in 10 years versus go up 10% or 20%. So what you have to look at is, what's the opportunity? I would say to you, do this. If you're looking for opportunity to grow that portfolio, maybe you should be looking at small cap and mid cap stocks in the U.S. Companies that could potentially be the next Apple. Look at ETFs. There's a number of ETFs out there that own smaller mid-cap, broad-based exposure, diversification, and I think you'll have a better chance to grow your portfolio in that category than buying Apple. I have to take a short break. Visit my website. Remember this, folks, you have one retirement. Don't settle for mediocre investment returns. Go to ReznyWealth.com, learn about our firm, schedule a consultation, and I'll be right back with your questions after this. Hello, this is Brian Rezny. If your goals are to increase your retirement income and retire without stress, go to my website and download our groundbreaking free report. This free report covers the investment and retirement pitfalls that are often overlooked even by the smartest investor. If you're concerned about outliving your money during retirement, or maybe you want to make sure you're not leaving money on the table, this free report is for you. Know the facts. Your retirement depends on it. Go to my website, reznywealth.com, and download your free report right now. And we're back, and of course we are taking your questions. Send them to Brian Rezny at reznywealth.com. And make sure you visit our website, reznywealth.com. We have a number of various free reports, not only about retirement and retirement security, but we also talk about suitability and your biggest investment risk, which I think is a must read. By the way, one of my groundbreaking reports, Why Annuities Are Dangerous for Your Wealth and Retirement, is available free on my website. If you've ever been pitched an annuity, if somebody's trying to sell you an annuity, or you maybe own annuities and you're finding they're not what they were told they were going to be, maybe you should visit my website. Download that free report and find out what you need to know about annuities and how they can be detrimental to your retirement and your retirement portfolio. Bill from Naples, Florida. With the market trading at close to a new high, should I be selling? Bill, great question, and I will say this. The market has been trading at new highs for the last 8-9 years. We have little dips in the middle, and the market seems to go to a new high. Just because the market's at a new high is not a reason to sell. Some of the reasons, or the main reason I will say that you need to sell or maybe reduce risk or hedge your portfolio, is if the economy actually is starting to slow down and roll over. And that would be a recession. I will tell you, we currently are not seeing the signs of recession. We may get a garden variety pullback of 5 or 10% this year. We seem to get those every single year statistically and historically. The key is these are usually short-term reactions and often a buying opportunity. If you go back more than 8 years, go back 20, 30, 40 years, we've had new highs in the market almost every single 3 or 5 year time frame, every decade. So the bottom line is this: as long as the economy is growing, as long as the world population is growing, and GDPs around the world continue to grow, which we're seeing, equity prices could potentially keep going up for the next 20, 30, 40,000 years. As long as we keep getting that growth, companies make more money and produce more products. So don't sell, don't make that mistake, because you're going to regret it ultimately. But make sure you do sell and reduce risk if we're showing signs of a real recession and a reason to hedge or sell stocks in your portfolio. Roger from Fort Myers, Florida. What if my company's 401k plan is lousy? What should I do? Bottom line is this, Roger. Most 401k plans that I've reviewed and my firm has reviewed over the years are usually not that great. They have a small amount of investments. Sometimes the investments are okay and sometimes they're lousy. What you're going to have to do is do the best you can with what you've got. Clearly, if I was an investor in your shoes, I would look at small and mid cap in your portfolio and potentially large cap if you're a long-term investor. Find out if you have emerging market exposure. Maybe you can balance that portfolio out. But contribute, especially if you're getting some kind of matching. If you are not working for that company anymore, you can always roll that money into a self-directed IRA and then have many other available options to you, and often I think much better options by rolling it into a self-directed IRA, creating maybe a potentially better investment strategy and having more control of your funds. But if you're in a fund or a plan and it's not that great, do the best you can with what you've got, and at the end of the day, move the money out when you're allowed to or when you retire or leave that firm. And this way you can have proper management and I think much better investments. Mary from Coral Gables, Florida. I own 4 variable annuities from Allianz. 2 are IRAs, 2 are individual. My advisor is recommending I transfer them to an Aviva equity index annuity and with security benefit. What do you think? Mary, do not do it. Let me tell you what's going on here. You're first off, your advisor is really a broker or a salesman of annuities. That's it. And he's clearly working under suitability because those are commission-based products. I see this happen a lot to investors. What your broker is trying to do is reload the commissions for him or her. That's it. They're taking you out of one product. You may have a surrender penalty to pay when you get out of it. They're going to put you in another product and reload you with a new surrender penalty and time frame. Don't do it. What you need to do is get a second opinion, get real advice. You're more than welcome to call my firm. We do deal with larger investors. Our minimum account size is $500,000, but call my firm for a consultation or visit our website, reznywealth.com. I will tell you, I see more investors hurt by these annuity salespeople, and you going from one annuity, and then he talks you into what's called the better annuity. Folks, there's no better annuities. It's called a bigger and better commission for your salesman. That's it. Do not be suckered into being sold the next better annuity. And if you're super smart, never buy an annuity, period. If you've already been sold one under misleading circumstances, get a second opinion. You have one retirement. Don't settle for mediocre investment advice, bad investment advice, or bad investment returns. Get a second opinion. You're more than happy to call my firm, Rezny Wealth Management, or visit our website. Joan from Fort Lauderdale, Florida. Can you explain fiduciary versus suitability? I sure can. Unfortunately, the vast majority of advisors in the United States work under suitability. I don't know if that percentage is 90% of these firms, but I know it's a lot. It's a big percentage. If they sell annuities, if they sell stocks and bonds, mutual funds, structured products, if they work on a commission basis, that is suitability. Suitability, all that means is they have to sell you investments, Joan, you are suitable for. So if you're 65, you want to be more of a balanced investor for growth and income, they can sell you a bunch of crummy, expensive variable annuities and mutual funds, and suitability has been met. They could be crummy returns, high expenses, but suitability has been met. Fiduciary, and by the way, Rezny Wealth Management is a fee-only fiduciary firm. We're an actual money management firm. We're not Wall Street and we don't sell product. We have to legally work in our client's best interest. When you hire us, we actually manage your money in your legal best interest. We have to always do what's best for the client legally. And because we're an SEC registered investment advisor, of course, that should be important to you, the investor. Fee-only fiduciary. I'll give you a little tidbit. There is no Wall Street firm, bank, or insurance company that is a fee-only fiduciary firm. There's some fee-based firms, but they also do suitability work and commission. You want to find fee-only. Go to my website, download for free our groundbreaking report and questionnaire, Fiduciary versus Suitability. It's your biggest investment risk report. It's on the homepage at the bottom. You can't miss it. Download it. Read it. It's simple. It'll teach you more about fiduciary and suitability. It is your biggest risk, and too many investors, in my opinion, 90% of investors don't understand the difference, and they're taken advantage of every single day because they didn't do their homework. I'm giving you the free report to do it. Go to reznywealth.com. You will be glad you did. Rob in Miami, Florida. Gold, silver, and gold stocks have taken a beating in the last 3 years. With these rock bottom prices, is now the time to invest. Rob, I'm not sure what you're looking at. First off, just because gold is up or down doesn't mean it's at rock bottom prices. If you buy any asset that dropped 50%, it could go to zero, or a lot, it could go obviously down another 20 or 30%. Bottom line is this: I don't like gold. Gold is often bought for real big inflation. We don't have that. Geopolitical events, we have those, but gold's not really reacting to that. Bottom line is gold is more of a sales pitch from a lot of these commercials. I would avoid gold. We currently don't own gold, and I don't see hyperinflation or a reason to buy gold currently. I would avoid all those that you're talking about earlier. Dean from Naples, Florida. Do you like small cap stocks? I sure do, but I would not buy individual small cap stocks. I would buy an ETF, an exchange traded fund. There's probably 20 to 30 ETFs currently in the marketplace. Do a little research that own a broad basket of small cap stocks. That's a great way to invest in small cap because you're already diversified and it's inexpensive. We've owned small cap in our portfolio for many years. Small cap has been a good provider of return long term. Of course, no guarantee to the future. But I will tell you this, if I look at where the opportunity lies the next 3 to 5 years, if I look at where I firmly feel the best opportunity is, it's going to be in that small cap marketplace. Small caps have a little bit more volatility, but at the end of the day, as long as you're not worried about short-term volatility and you're a 3 to 5 year investor with some of your money, I think almost every investor should have a portion of their money in small cap. And I'm not talking 1 or 2%. 5 to 10%, maybe up to 20% if you're more a growth-oriented investor. But small cap stocks are what grew into the next mid or big stock. Remember that. All small cap or all big companies started small, and you have the opportunity to grow. Small can grow faster or have the opportunity to grow faster than large. If you're overlooking it, I think you're making a big mistake. Sharon from Bonita Springs, Florida. My broker wants me to cash in an annuity I have for another he says is better. I have been burned before on annuities. What do you think? Sharon, you're going to be burned again. Annuities are not good for your wealth, nor are they good for your retirement. Go to my website, reznywealth.com, and download for free Why Annuities Are Dangerous for Your Wealth and Retirement. They're expense-ridden. They insanely lock your money up. The only reason your broker wants to sell you the better annuity is for commissions. Don't be a sucker. Don't be sold. Get a second opinion. You're more than happy to call my firm for a consultation or go to reznywealth.com. Results, retirement security, and peace of mind. Every single day, we receive calls from investors just like you. Remember, I tell you all the time, you have one retirement and only one portfolio. We want you to experience the difference we provide. If you're like many investors, you're tired of Wall Street conflicts. You're tired of the bad advice. You're tired of poor investment performance. You, the investor, need to understand. You never want to settle for mediocre investment advice. Your retirement is far too important. If you're concerned about the results on your money, if you're concerned that your advisor is not looking out for your best interest, if you've done a little research and realize Wall Street's not your friend, annuities are not your friend, and structured products and all these crazy things they come up with, call Rezny Wealth Management. We work with larger investors, $500,000 on up. If you're one of those investors and you need help, call us today. Schedule a consultation and feel good about your portfolio again. It's important you, the investor, don't settle. Again, remember, one retirement. Don't let it pass you by, and never settle for bad investment advice ever. Go to reznywealth.com and make sure you listen to my next show next Sunday, and make sure you have yourself a safe and profitable day.